Test 1, 2, 3. Welcome everybody joining in. I'll do a quick shout out to some of the names popping in. We've got Dean Gallagher from our team, option coach, Gene Geronimo, James Herb, John Nestor, Karen Helper, Tom Sharp. We've got a mix of clients and potential clients today. Welcome.
Hello.
Hey Tom, how's it going?
Great.
Excellent.
Hey Tom, hey Jason, how are we all doing?
Doing great.
Nice. Tom, are you enjoying that boot camp?
Yeah.
Nice.
Hey Karen, how's it going? You got your microphone today?
Yeah, I just have a few minutes. How you guys doing?
Doing good, doing good.
Staying warm?
Hello?
Hello, thanks for calling in. I don't see your name, but I see your phone number's ending in 1023. We can hear you. Oh, they hopped off. We'll get started in a minute. Give people a minute to join in. Let's see, Gene, James, John, if you have a mic and want to say hello, we welcome you to open up your mic and say hello. Tell us where you're calling in from.
Calling in from a cold Allentown, Pennsylvania.
Oh, Burr. What's
Not so bad today. It's I think 21. It was around 10 yesterday.
Yeah. Are you a fan of the cold or not so much?
No.
No. Yeah, here in Albuquerque, it's actually quite warm today. I just got done with my daily dog walk and was in shorts.
You're making me jealous. Or is it envious? I forget.
Right. So tell me about your experience following our program so far, James. You've been taking.
Well, I just really started yesterday. Victor got me hooked up with your noonday call.
Okay.
And so I've been watching videos and impressed so far. I haven't done any trades. But, you know, I mean, it's basically what I'm looking for, steady Eddie, not too much risk.
No.
I like your diversification, your asset allocation mix is, you know, music to my ears. You're preaching to the choir, as they say. Nice.
Well, that's what I've found with our program. You either get it or you don't. And if you get it, you see extreme value. And if you don't, you want to just buy and hold stocks and hang on for your life.
You could do both.
You can do both, sure.
You can have your cake and eat it too.
As long as the little kids don't run off with your cake while you're not looking, I guess.
Well,
Wendy, welcome. Thanks for joining. I see your mic's unmuted. You want to tell us where you're calling in from today?
Oh, can you hear me?
I sure can.
Colorado.
Oh, cool. So you're just, are you in Denver or?
Yes.
Oh, nice. That's definitely one of my favorite cities.
It's booming here.
Excellent. Now, what's your experience with our program so far? You've been watching? You've been taking any trades?
I'm just learning about it.
Okay, so you're right at the beginning there.
Mm-hmm.
Excellent. Now, James, thanks for your comments early on. Just curious, are you all in on stocks? Do you have any bonds, any downside hedge, gold? And I think you did mute your mic, so. And then I also see Gene is unmuted. Oh, Gene, I allowed you to talk. I just hit the button, so you should be able to chat now. That's not working for you. Might have to promote you to a panelist. And Wendy, are you all in on, do you have a stock portfolio, a bond portfolio? Are you highly diversified with uncorrelated assets, or where are you at in life right now?
I have a stock portfolio, a mutual fund portfolio, which I'm not really proud of, but I'm old, so that came from the past. And also, I've been trading options too.
Okay. Now, you're retired, I assume?
No,
Oh, okay. What kind of work are you in?
interior design.
Oh, nice. Okay, cool.
I want to retire.
Well, hopefully we can help you supplement that income and protect the nest egg. I'm going to leave everybody's microphone unmuted. I welcome you to interrupt me at any time. No question is unwelcomed. And so please speak up at any point during the presentation, and I'll take plenty of time to pause and see if anyone has questions out there. Goal of this webinar is to really give you a very clear idea of what our trading strategy is, why it works, and then also what might make it not work, and how we would react to those outcomes. And in fact, what I'm going to outline is my prediction for how the bond and stock market bubble pops in two different circumstances. So we got one circumstance where everything's rosy, stock market keeps climbing higher and higher, and there's no China trade war, there's no impeachment, there's no global slowdown. How that could play out for maybe 2 to 3 years before things get very hairy. And then on the other side of the coin, which I'd argue is maybe a slightly higher probability of actually happening, is that the Chinese don't want a trade war. They don't want Trump in office. Everything escalates, tariffs go higher, the impeachment inquiry gets very fearsome, and protests in Hong Kong get out of control. So we'll look at two outcomes, one that's fear-driven and the other that's inflation-driven in terms of causing trouble for everyone's nest egg. And what's really important about this presentation is I want to make it crystal clear to you why the crisis ahead of us is nothing like the dot-com bubble or the 08 bubble or even the crash in the 90s. It's not just an 11-year business cycle we're in. If you really look back, we're really in a 40-year business cycle. And I'm going to show you evidence that you just cannot dispute. Anyone can look at this chart and understand why we have some serious trouble ahead. Okay, so please, if you have any questions at any time, stop me. And that goes for you, Tom and Karen. Tom and Karen have bought all the products we have to offer. They show up for all our webinars. They're very loyal clients, and I appreciate you guys coming on too. So if you guys want to say anything about the program later on in the presentation, you're welcome to as well, or if you have any questions. So thanks for joining us and being such astute students.
Hey, Jason, going to jump in really quick too. And James and Wendy, just wanted to let you know too, folks, the best way to test drive, let's say like you're going to a car dealership and you're thinking about buying a car, the best way to feel it out and understand if it's, something you like or not is to test drive it, right? And what I always tell people is during your free trial, get in there and test it with either paper money, and you can do the 75K allocation or do 150K or 225 or 300 or whatever amount of capital you want to test with. But that way you can maximize your free trial, take the car out for a drive without having to buy it, right? And without having to use real capital at all, no paperwork, it's a really, really nice way to be able to test it, see your results, but not have any risk on the table. So I would highly encourage you to do that during your free trial.
Thank you. I don't know what platform Wendy uses, but I know Thinkorswim allows you to paper trade. Yep. And there's probably quite a few other ones that also have that.
Oh, you're fancy, huh? You're on Thinkorswim?
Yeah, I've been there for 20 some years. I was one of
Nice.
Tom Sosnoff's original customers.
Wow. Oh, wow. Yeah, I know. It's a great platform. Much more complex
Tasty work.
than what you'll need for our program, but certainly. Okay, great. Well, I'm going to hop into some content here, and then feel free to interrupt at any time, guys. Really look forward to communicating with you. What you're not going to get today is a big hypey sales pitch. You're not going to get anything of that nature. Our whole business model has revolved around giving away the program, showing results, making people wake up and realize that they're gambling their retirement portfolio, and then figuring out that they want to play it safe moving forward. And instead of worrying about how much money you can make, now we're much more concerned about protecting what we have and just trying to pick up the low-hanging fruit. So our goal is to generate 1% a month. Our average return has been to date in 11 months, so it's not the longest track record out there by any stretch, is 1.35% per month. I am not trying to achieve a return greater than that. And you'll see the bigger return you're trying to achieve, the more risk you're going to have to take to capture that potential profit. So this is, excuse me, let me grab one slide for you guys here.
What do they say? Pigs get slaughtered.
Yeah.
That old saying. And
Yeah,
obviously,
what is it? The bears get, the bears, I forgot the saying, but yeah, it ends up with the pigs get slaughtered and I can't remember that saying. I've heard it though.
yeah, I mean, you obviously could go for a higher return if you're willing to take more risk, but your portfolio is much more diversified, with the gold and the bonds. I guess, you do put eggs in different baskets. So that will bring down your return, but then in a time that there's a pullback, you're not going to see as large of a loss.
Actually, we tend to make money when there's equity pullback. So that's a great point.
What, because of volatility?
I'll show you. Give me a minute. We'll jump into that in a second. So, okay. So the program is a daily income trade alert at noon Eastern, Monday through Friday. The target return is 1% a month. We've averaged slightly higher than that, 1.35. There's been months where we're underperforming, and that's typically when I'm concerned that there's trouble ahead, that there's a conflict that has not been priced into the market. You'll see that's when I'm going to play it extremely safe. And sometimes that means we take a small loss, even though we were playing it safe. But so far in 11 months, the worst drawdown we've had in a 30-day period was a loss of 1%. And this is during a period where there's been extreme volatility in equity markets and in the bond market recently as well. So over a 90-day stretch, we haven't lost for investors, period. And what's important is that the trade alerts come out at the same time every day, and we're trading the same assets every day. So the result is that people actually get the same profit and loss that we're reporting, which is such a breakthrough for advisory products. And my background was actually doing the marketing and management for just about every advisory you could think of under the sun. And what I came to find is that very rarely does anybody get the result of the advisor. And there's a million reasons why, but one big reason is you can't predict when the trade alert's going to come out. That's number one. Number two, a lot of these advisors will fire off trade alerts left and right, but the losers, they try to sweep under the rug. All of a sudden, they don't even know what you're talking about. So they'll go on bragging about all these closed profits but they're just sweeping all the losses under the rug. The next problem is that a lot of these advisors don't have a real portfolio where you have a total amount of capital to invest. So they're giving you trade recommendations without position size. And now all of a sudden, you don't know how much capital to put into each trade. So the goal of this program was to create a passive income trading strategy where we never touch the trades outside of our trading time, which is noon Eastern daily. And then to make it very, very simple to know how to allocate your capital. And then furthermore, we've added some options into the strategy to make it even safer. And James is absolutely correct. The whole strategy here is to layer on different assets that are uncorrelated. So what that means is we're going to generate profit in each asset at different periods of time. And then our goal is to lock in those profits each month with our options. And so typically, and as you'll see in this presentation, typically the SPY and TLT will travel in opposite directions at any given time. But in general, they're traveling higher together. So it makes for a very simple and effective strategy. And so we'll go over why emerging markets, why GDX, that's your gold miner, during this presentation as well. But the core of this entire system revolves around trading the stock and bond market together in tandem. And the TLT and SPY end up acting as an insurance policy against one another. And that's the whole secret sauce to how we're able to generate such consistent returns with low volatility. Okay, so this is our current strategy outline right now. Once we get a few more slides into this presentation, you'll understand why this is our allocation currently. And by the end of this presentation, you'll see why this strategy will most likely break within the next 3 years and what we're going to do about it. And this is going to be a big problem for most financial investors, hedge funds, mutual funds, pension funds. They all rely on this relationship remaining intact. And the bad news is that the Fed is running out of ammunition to keep this relationship between the stock and bond market in a healthy perspective. So let's go to the next slide.
I have a question on that last slide.
Sure.
The 50% equities, does that include both the SPY and the EEM?
Yes, sir. And actually, I need to update that. We're actually at this ratio right now.
Yeah, great question, James.
And another thing, James, if you wanted to simplify your life a little bit with our program, you could totally not take the emerging market trade and then also not take the gold trade and just trade the SPY and TLT and get very similar results.
You've back tested it?
And then alternatively, if you really want to start off with less capital and have a very similar outcome, this right here just trades Tuesday, Thursday, emerging markets, and the TLT. So we have a few options if you don't want to place as many trades. And we'll get into the details of that in a minute. Now what I want to do is just kind of show you visually how well the bond stock strategy works in different market environments. And so I don't have a magic ball. I try to get the big picture correct, but the market will unexpectedly sell off and catch people off guard. And so in December, we had no way to know if that was going to be the end of the crash at December 24th, or if this was going to turn into another 2008 moment. And furthermore, we had no idea that the plunge protection team would come in and rescue the day and send stocks flying back higher. But because of our strategy and the put options that protect each asset class, we generated a nice 1% profit when the S&P 500 fell 18%. So the S&P 500 is up a little over 20% if you magically had bought at the very bottom of the crash. but the risk to reward ratio is about 1-to-1. You've had to almost take on 20% of risk to achieve a 20% gain in 2019. That's not a very good risk to reward ratio if you're trying to protect your capital and consistently generate profits. So in January and February, we underperformed the S&P 500, but that's the whole point of this program. We're not trying to beat the S&P 500. We're trying to make a very rock solid weatherproof portfolio that can make consistent profits with low risk. If we go to March, April, May, and June, you can see we've had another volatile period of time on the S&P 500. But what's most important is look at May. I had no idea that all of a sudden we'd have this sharp reversal in the S&P 500. This was a crash of 7%. Who would have known when it would stop and when it would rebound? And what you're going to learn is that the TLT saved the day in both the December month and the May month because the SPY tanked, it got protected by our put option, and then the TLT flew higher. And so that is the relationship that makes this portfolio so strong. Now, if we go to the next month, in July, I was highly concerned that the trade deal was going to break down. They had this meeting at the G20 in Osaka, and sure enough, you know, they've got a farm deal in the wraps. That's what they told us. Market loved it, shot up higher. I had us positioned in case that didn't happen. Okay, and then guess what happened a month later? At this point, I was convinced Trump was going to kick the can down the road and just try to win the election. Worry about China in 2021. Oh no, come out August, we've got new tariff threats and the market tanks 7% again. Well, the same thing happened. We didn't see this coming from a mile away. We knew there was this tension, sure, but once again, the SPY sold off or put option kicked in and the TLT went up in value. So that delivered a 0.8% return. The last 2 months have been tough. We've seen mixed messages. We had China buying agricultural products, which they had almost completely halted. Then we had Vice Pence, Mike Pompeo, and even Trump on a world stadium really denouncing and demeaning China. In fact, they're even putting sanctions on new companies leading up to that October moment where all of a sudden they came up with this grand term, the phase one trade deal. Markets shot up higher from there. And now we're back to square one. China's backpedaling, and maybe they don't really want a trade deal. Maybe they just want to get Trump upset and try to create a recession so that they don't have so much political pressure from the United States coming into the next election cycle. So you can see the strategy works remarkably well when there's pullbacks in equities. And now that we're sitting near all-time highs, the VIX is at a record, well, it was at a record low. Positioning is at near 100% in equities, and now the trade deal is looking like it may not happen. So I think we can all predict what happens next, or at least what a highly likely outcome is. And that is Trump raises the tariffs and equities sell off. So our simple 4 ETF portfolio is extremely diversified and uncorrelated, and it's really all you'll need for retirement. The SPY ETF has 500 companies in it. The emerging market ETF has 1,000. GDX has just under 100 mining companies for gold. And then the TLT is your 20-year treasury. So that's the tax receipts from all of America's corporations and 350 million of the highest paid individuals in the world. So it's hard to get a safer portfolio, especially when you put in the options that we add on our portfolio. And again, the goal is to create income and safety. You're not going to fall in love with this product if your goal is to get growth or speculation. And we got a few new folks hopping in. I think these guys are actually, Donald, how's it going? Donald's a member. And D. Hillstrom, I'm not sure if you remember or not. I know you've been on a lot of webinars. Welcome. Thanks for joining us. I've unmuted you if you want to say hello or ask any questions, please go for it.
Thanks, Jason.
Hey, Donald, how's it going, bud?
Good.
Nice. So the goal of our program is to help investors simplify your holdings, reduce your risk, get better results with less work, and most importantly is to weatherproof your retirement portfolio for the storm coming. And most people can't see this storm coming, even though it's right in front of your nose. So we'll be getting into that in a minute. I do want to throw out that if you do call Dean today, he has some discount codes he's handing out that we don't normally do. So don't be shy to give Dean a call. Okay, so this is part of a presentation we give to our boot camp group, which is a high-end 16-week educational program. And it really goes through the big picture. Now, to be real, this presentation could be expanded upon and be something like 50 hours long. It's about an hour and a half of content, and I may not get through all of it today, but it's going to give you guys a very good idea of how our strategy works, why it works, what could potentially break it, and that would be, again, the two big bubbles popping. Okay, so there's a million things out there that you could be paying attention to. My goal is to try to simplify it to much less. And so if we actually just track 3 core items, you're going to see your life gets a lot easier at predicting the big moves. That doesn't mean we're going to be able to predict what happens today and tomorrow, or that we're going to get 100% win rate on our trade alerts. But if we understand the big direction that the markets are heading, and that's primarily the equity market and the bond market, then we can place very similar bets over and over and over again and have a high win rate. And that's how we're able to generate consistent returns. So the first thing that is critical, especially in this day and age, where we have a hyperactive Federal Reserve, is whether they are buying or selling treasuries. Okay, so 2018, all the central banks teamed up together and said we're going to hike interest rates and sell off treasuries, bonds. And so what did we get? By the end of the year, 98% of all asset classes ended the year in a loss. The only thing that could have made money from the start of the year to the end of the year was being long the volatility index. Okay, so that's the most important thing that we want to be tracking. And right now, we're in a period of pretty heavy stimulus. They're calling it not QE, but just in the last 2 months, they've added $250 billion to the balance sheet that's permanent, and they've created an overnight lending mechanism that is giving $180 billion of liquidity that's rolled over night after night. So we're in a phase where the money supply is expanding and the central banks are taking pressure off of their bond markets. Why are they doing that? Well, they're trying to keep their governments funded because they're creating deficits at a pace greater than their tax receipts. So we'll come back to how that all plays out in a moment. Here is the next most important item, and that is whether the Federal Reserve is raising interest rates or lowering interest rates. And so this is the most important chart in the world and why the 40-year bull market can't turn into a 50-year bull market. Now, what I want you to pay attention to is the interest rate we had right here in 1980 spiking to 20%. And so we went through a 40-year period of lowering federal funds rate. That's the cost of money. Now, what happens when you lower the cost of money? Asset prices travel higher. We're talking bonds, stock, real estate, everything. Okay, so the key here, though, is the change of the cost of money. So we went through a period of time where we were able to almost systematically drop the cost of money for 40 years straight. Now, sure, every once in a while they would try to spike up the interest rates again, and that's the next slide. inflation. That's the only thing that makes them increase interest rates. But every time they try to spike those interest rates, what happens? You see those gray lines? Those are your recessions. And so we've gone from very expensive cost of money, which gets pretty much all malinvestment out of the economy. Think about it. If you're going to borrow and you have to pay a high level of interest, you're not going to be making any stupid bets with your money. You're going to borrow only what you really need and make sure that investment turns a profit. What happens when you have a 0% interest rate? Well, now you're going to have massive malinvestment. There's no risk. You don't have to pay any interest. And so we're now in a period of time where in the last decade, we had 0% rates and have created massive market bubbles around the world. And so the other thing that I want you to pay attention to is the cut in rates that was required to pull us out of the last 3 recessions. So in this example, rates were cut from 10% to 3%. They slowly worked them back up once they were confident everything was hunky-dory. And boom, dot-com bubble hit. They had to cut rates another 5% to save the day. But it didn't last very long now, did it? They had to spike those rates back up, hoping everything would be all right. And then we got the housing bubble. And then they pushed the rates down to 0, the lowest rates in over 70 years. And where are we at now? We're back to lowering those rates right back down to 0. And I do see some more people hopping in. I just want to say hi and welcome. DMI Global Partners, welcome. Thanks for joining us live. If you have a mic, love to hear your voice and say hello. Okay, so the next most important thing I'm tracking is inflation. And maybe it's not even real inflation, but what we want to pay attention to is when the central bank thinks there's too much inflation, that's going to cause them to act and change their policy. And the 2 policies we're, again, most concerned with are whether they're adding or subtracting to the monetary supply, and whether they're cutting or raising interest rates. And the important thing to note is that every time inflation does get out of control, the Federal Reserve has a very, very simple formula to deal with it. And it involves dramatically increasing the cost of money. And all of a sudden you fix your problem in terms of price control, and you end up with negative GDP prints, stock market crashes, bond market crashes, and a whole host of problems for the financial system. So we'll come back to this in a little bit and go through history all the way back to World War I. And we can see every time inflation gets out of control, and in some rare cases deflation, we end up with a period of time where investors lose substantial amounts of capital. And what I really want to make sure we all understand is that we're not in the 2008 period, we're not in the dot-com period, we're not in the 1990s, where we have room to keep cutting rates. We're at the very bottom. They can't cut the rates. They have 1.5% they can cut them, which is about a third of what it's taken in the past to save us from a recession. And then they're out of ammunition. What's most likely to come in the near future for the rest of your retirement is most likely the opposite of what we just experienced for the last 40 years. More likely, we're going to be dealing with rising inflation and rising rates, which creates some of the worst outcomes for the Dow and for the bond market in history. And so we'll see that in a minute. But if you think you can buy and hold through a year and then be back to even, so you don't have to realize your taxes, that might not be the case. And you're going to see during this period of 1965 through 1980, you would have lost money for 15 years straight. Okay, so this is our current outlook and strategy. We're in a low rate environment with low inflation. We're having light quantitative easing. And so this creates a bubble. And right now, there's not a major fear factor. There's nothing really going wrong. There's no big bankruptcy. We have a global slowdown, but nothing is causing a panic yet. And so this is our current setup in our portfolio. Somebody have a question? We're getting a little reverb. Okay, Wendy, if you have a question, just hit the raise your hand button and I'll bring you back live, okay? And looks like Hector joined us. Welcome, Hector. If you do want to say hi, I've unmuted you as well. All right, so let's take a look at some charts now. What I'm going to do after this is actually look at two outcomes and how I can see in one outcome the stock market crashes first, then the bond market, and in the other outcome the bond market crashes and then that pulls the stock market down. And we'll also look at timelines when things might reset and where a lot of this information comes from. Okay, so in this chart, we're comparing the S&P 500 to the TLT. And all that I really want you to gain from looking at this chart is to note that in the environments where the S&P 500 sells off considerably, we know that these were both around 50% crashes, you can see the TLT spikes. In fact, it almost spiked more than the crash. So it's showing a total 71% gain over this period. But the important thing is this nearly went up 50%, and that's almost exactly equal to how much the SPY sold off. Once again, when this sold off here in 2012, we had a huge spike in the TLT. During this period, the S&P 500 flew straight up, but the TLT did not get killed. Sure, it had some volatility and some drawdown, but it didn't destroy your results. We get another little panic right here and here, and you get another big spike in the TLT. Then we get to the Christmas massacre at the end of 2018, and that was your bond yields getting too expensive. Money just jumped ship. And what do we get? Another jump in the TLT. Okay, so this is really the core of our strategy, is to understand that the TLT will protect our equity position. And in this chart, we're just looking at the TLT. And once again, you can more clearly see the spikes in value in the bond prices during times of panic. Now, on this chart and the next several charts, I've actually zoomed in on a few time periods just so you can see what's happening. So in this example, we're at the 2009 crash, and we can see the S&P 500 had a maximum drawdown of around 50%, and the TLT rose around 40%. So once again, without really knowing how, why, or what, a simple stock bond portfolio didn't have too much drawdown if you were just long both of these assets. And throughout time, you can see this correlation remains intact almost all of the time. We've got another person joining in. Welcome. And anybody joining in late, Saturday we send out a free replay of this presentation so you can catch up on the content. So once again, stocks go up, bonds go down, bonds go up, stocks go down. But in general, from 2010 through 2012, they both traveled higher. So you didn't miss out on too much of the profit of the S&P 500 by having a large TLT position. But on the other side of the coin, if there had been a massive crash, you were primarily protected. Hector says, is there a volume control? I can't hear anything. Probably on your computer, buddy. Look for like a little speaker button in the right-hand corner. You might have your mic muted or your speaker muted. Okay, now moving along, here's a rapid rally in the stocks for 2013 to 2015, a 51% gain. TLT had a maximum drawdown of 20%, but ended the period only down 2%. So it diluted your profit, but again, it provided that insurance policy you need to protect your assets. And the correlation continued into 2018 until finally we got that nasty sell-off in December. And once again, the TLT flew higher during this period. Now, in 2019, we've had an interesting correlation where they're both traveling up together. And so we'll take a look at why. Meanwhile, another aspect of our portfolio has been playing the gold market. And in this chart, I want you to note how volatile the price of gold is. Now, if you can predict the direction of gold and then use options to help protect and safely profit from that, playing the gold market can be highly profitable in both directions. And so to simplify it, there's really three things we look for to be long gold. Number one is the Federal Reserve increasing the money supply by buying bonds. Check mark, yes. Now, people were predicting this would happen way back in December of 2018. And sure enough, the Fed went from very hawkish to becoming very dovish the second the stock market started to sell off. And so that's check one. Check two, are they lowering rates? Well, sure enough, they've lowered rates 3 times. And once again, the gold market predicted that. That's why it's up so much this year. And then the last item that magically makes gold go up is panic. So if we have the first 2 ingredients, we may have some drifting lower. But the second you add panic, assets like gold really skyrocket up. And the main reason why is because the value of your currency is being devalued by your government. And so importantly also is the comparison of the TLT to gold. A lot of times they are correlated, but not always. And if we were actually to look back to the period of time I think we're heading into, you can see they can absolutely go in opposite directions. So once again, by having gold in our portfolio, it adds another layer of uncorrelated diversification. Now, we were playing spot gold all year, predicting these events would happen, and did well with that. But soon as gold got to 1,500, we rotated out of spot, which we use GLD, into GDX. So the main concept here is that if prices of gold are going to remain elevated and potentially hit a ceiling because central banks are loading up on gold as they increase their money supply and want to remain credible as a central bank and as a currency, well, then we can predict that the benefactors of an elevated price of gold will be the gold miners. Now, the catch is these poor gold miners have had a rough time. Most of them have been losing money and on the verge of bankruptcy. So you got to be very careful with which gold miners you want to own and when you want to hold them. So it is certainly a risky asset, and that we don't pretend that it's not. We know that going into it. So we make sure it plays an important piece in the puzzle of our portfolio. All right, so now what I want to talk about is, what would make this simple strategy of just owning stocks and bonds break? If it's really that easy, why doesn't everyone just do it? Well, actually, I got a news flash for you. Everyone does do this. And that's the big problem. When certain events happen in the future, it's going to cause massive losses to people who rely on that relationship breaking down. So I'm going to give you 2 outcomes for how these bubbles pop and how we can adjust our portfolio to deal with this and sustainably remain profitable while protecting our portfolio. Okay, so let's talk about how the bubble pops with no China trade war and no impeachment pressure. I would bet this has less than a 50% probability of happening. But so far, that's been the narrative. We've had little tariffs here and there. China's offset those tariffs by devaluing their currency a little bit. But there hasn't been major blows at all to each other's side yet. So now they're talking about a phase 1 trade deal. And everybody has their fingers crossed, their toes crossed, they're jumping up and kicking their heels. Let's just assume everything goes hunky-dory. What could happen? Well, this is our current market position right now for this exact environment. This is a low rate, low inflation QE bubble. And there's a little more detail to it, but we know the government's creating deficits at record pace. That means we're going to have pretty strong GDP. And of course, it is at the cost of growing debt. But because the Fed knows in order to keep people holding their bonds, they have to force this bond bubble higher. Otherwise, everybody's going to run for the exit at once. And nobody wants to have their government become unfunded. So this creates an environment where you can be long stocks and bonds at the same time, as well as gold. So this is our current outlook on the markets right now. This doesn't mean I might, for a very short period of time, bet down on an individual asset if I think it's become overbought. And so from time to time, we can flip that plus to a minus, and I'll show you in a minute how we use the option market to do that. Yeah, I think there's going to be a lot more tariffs coming, James. So, okay, so what happens if we stay in this environment for too long? Well, if you listen to Larry Kudlow talk about how we're going to deal with the deficit, his solution is to get the GDP above 3%. He believes if we get the GDP above 3% for a long period of time, we can get a greater amount of growth, GDP, than we're creating in debt. The problem is we're creating about 50% more debt than we are GDP growth. So that formula is just not working. And in fact, just the interest payments America owes per year is $500 billion. So Trump's worried about a $500 billion deficit in trade, but our interest payments alone are that size. And this, the projected 10-year outlook from here is that we'll be at $2 trillion a year of interest if we keep things as is. So eventually, the prediction is that you get rising inflation from too much quantitative easing, and that causes your bond market to pop. So if everything goes hunky-dory, my expectation is the SPY travels higher, gold and silver slowly drifts higher, and we get a sell-off in the bond market. All the money is flooding out of the TLT, and just look at what happened when the phase one deal came in. We saw a huge rotation out of bonds into stocks. Okay, so that can go up for so long until your yield on your treasury gets too attractive. Okay, so this is where the stock and bond market are just whiplashing one another back and forth. So again, we don't have any fear in the market. There's no panic. The Fed's becoming accommodative. They're still doing QE. They're still expanding the monetary supply. They're still supporting the bond market. Eventually, your bond yield gets too attractive. And I'd like to point back to October of 2018. Your 10-year treasury hit 3%, and that is just too good to turn down. If the expected inflation rate is somewhere around 2%, and you can go get a 10-year treasury that's paying you 3%, you better bet your bridges that all the banks are not just going to go buy that, they're going to leverage into that with every penny they can because it's a guaranteed profit. And so that is what potentially was the main cause of that December crisis. That was a 3-month sell-off in equities last year. Everything looked great. Stock market was going higher and higher by the month. And all of a sudden, those treasury rates got too attractive. Okay, so this is a setup where you get your stocks to sell off and the bonds rally back. So nothing too terrible yet. And in terms of timing, my expectation is this could see a stock rally into 2021, 2022 at the maximum. And again, this is without any fear, panic, problems. Everything's rosy. We have accommodative Fed. And then finally, your bond yield just gets way too attractive. And you just have the stock market and bond market playing tug of war. That's not a big deal. And once again, just being long the TLT and SPY would deal with that effortlessly, mindlessly. But then what happens? Well, the problem we could find ourselves in is that we print too much money. And by popping these two bonds, bubbles, first the bond bubble, and then the stock bubble, we're finally going to get all this money that's been trapped in assets and get it into the actual economy. And all of a sudden, you end up in a period that you didn't see coming. And that's rising inflation. When we have rising inflation, the Fed has no choice. No matter how bad things are, they're going to have to rise interest rates to curb inflation. We'll look at some charts, but I can show you without doubt, they have a very clear protocol for dealing with inflation. And it's very simple. They crank up that interest rate 1% to 2% above the inflation rate. They make the cost of money more expensive, and you get rid of price inflation in a snap. Now, the problem is the way we create GDP growth is by expanding the debt. And when we stop expanding the debt because it comes too expensive, you get negative GDP prints. So as you're going to see in this presentation, we can end up in a time period where we have to be short stocks and bonds because the Fed is in a period of rising interest rates. Now, this is a period where you actually want to have some dollars saved up to put in the bank because they'll pay you a better return than just about anything else could. Now, that is assuming you don't know how to short these assets that are severely inflated. And then the final period of time is your dropping rates and then expected QE. Now, this could be at least 7 years away. If you listen to Ray Dalio, Stanley Druckenmiller, they think this is going to last a long time. And when we do look back in history, the last time this pretty much played out exactly, it was a very, very tough environment to make money before we finally got rates all the way up to 22%. And then that's the 40-year bull market we all know so well, that we all trust will rebound and that the Fed can save the day no matter what. Okay, so how can the stock market and bond market pop with pressure from China, trade war, or the impeachment? Okay, so we got low rates, low inflation, quantitative easing, and now throw in some fear. That's what I actually think is happening in the next 4 weeks or less. And so we haven't quite yet pulled the trigger on shorting the SPY emerging markets yet, but we are reopening our position to be long the TLT and GDX after sidestepping that, trying to sidestep that sell-off in the TLT over the past few weeks. So this is our strategy with fear added. We're ready to be short stocks in emerging markets for short periods of time, but if credit is cheap, it's going to be very hard to stay bearish on equities for a very long period of time. So in this instance, I'd suspect a short-term sell-off, and I'm talking maybe 2 to 6 months at most in equities, and a massive rally into bonds and gold. So this could be right around the corner if we don't get a trade resolution really in the next few weeks. Because if you remember, Trump told us we're going to be signing this deal on November 12th. Well, now it's November 14th, and there's no trade deal. All right, so you get a stock sell-off, bond market rallies, Fed comes to save the day. They dramatically lower rates and print money, massive QE. Think of 2009, how they saved the day. And you get that same tug of war. Now the stock market's rebounding and bonds are selling off as stocks have been repriced dramatically lower for potentially 2, 4, maybe 6 months at most. Now your bond market's selling off. Your risk assets are going up, and we enter a period once again, money's escaped the bubbles, and we end up with inflation. And inflation once again turns into rising rates, and now you have to be short the stock market and bond market at the same time. And then finally you get back to your reset, where you can go from high interest rates down to low interest rates, and for a considerable time frame. Okay, so what else do we add to our strategy to make it so we can own these same assets regardless of the direction of the asset. So we really have three setups. We have the loose option caller. This is where we're selling an out-of-the-money call option and using it to finance an out-of-the-money put. And so this will be our riskiest setup where we're bullish on the asset class. And so all that means is we're selling the call option way above the strike price and we're buying a put option way below. The call option's where we get cut off in terms of potential profit, and the put option is where we get cut off in terms of potential loss. This is a trade we've been doing on the SPY the last several weeks, realizing this is a very risky time period. We did predict the SPY would be traveling higher on hopes of a trade deal, but we know it's one tweet away from disaster. So in an environment where we're concerned that this was overbought and could sell off rapidly, we want to have a tight option caller. And so this has been something we've done over and over and over again, really for the last 6 weeks, very consistently on the SPY. And the higher we go without a trade deal, the tighter we will get. Now, eventually, when we have a catalyst, we want to bet down. And this is, now in this example, we're selling the at-the-money call right above the trading price, and we're buying the near-the-money put right below the trading price. You can see we actually generate a small profit if it goes flat up or slightly down. But our maximum risk is much less. In the loose caller, we can lose $3 a share, or about 1% in a 48-hour period. On a tight caller, our maximum loss is only 1/3% in a trading period. And the final strategy that you have to have in your toolbox is the inverted option caller. So this is the only safe way to bet down on an asset and consistently make bread and butter type returns. And so we love to bet down. Rarely have we had the opportunity to do that this year, but this is where we sell an in-the-money call and then buy an in-the-money put. And we can actually have a really nice risk to reward ratio because the market is not engineered to go down. So they pay much better for you betting down than they do betting up. Now, of course, those dynamics will change once volatility does spike. But you can see this is how we can own an asset like the SPY or the TLT and safely generate profits to the downside by using the 100 shares to sell a very juicy premium. So in this example, we get 219, and then we can use that 219 to buy a $300 put, which has greater value than the SPY at that moment in time because it's above the trading price. So we can actually generate consistent profits in a downward move with the inverted option caller. So we're not going to be changing the assets in our portfolio, but we will be optimizing the option caller based on what we see coming down the pipeline. And once again, I do want to remind everybody, if you do like what you're hearing, you want to join us, call Dean at 505-322-7515, and he gets you a discount on our membership. Okay, so now what we're going to do is jump into some of the content of what's actually in these ETFs.
Hey, Jason, I want to just pause you for a second. Team, does anyone have any questions as we're going through this? I know Jason flies through a lot of content pretty quickly, so I just wanted to.
Question we should ask about this one specifically.
Yeah. Does anyone have any questions about that? So what he's showing here is basically a piece of software that we use to analyze the options that we engineer. And so if you guys have any questions on what this is, why we use it, please just jump in. I know it's a lot, and Jason knows this like the back of his hand, but please, any point in time that you don't understand what we're doing, just jump in and ask questions, okay?
You're only selling and buying one contract?
No. So the ratio is 100 SPY. It's so easy to remember. That's what I love about the strategy. Your ratio is 100 SPY, 200 TLT. So that's the basic fundamental strategy. And that's because the SPY costs twice per share as the TLT in general. In terms of GDX and emerging markets, it's 200 shares of each of those as well. And so we're trading the SPY Monday, Wednesday, Friday, emerging markets on Tuesday, and then the TLT and GDX on Thursday. So that takes 75 grand. If you had 150 grand, then you would do 200 shares of SPY, 400 TLT. If
Right,
you
it's
had
fourth on the way up.
225 grand, then you can do 300 shares of the SPY. And now, to be honest, James, a lot of our clients are trading upwards of $500,000, and quite a few are in the seven-figure range. So,
Okay, I wasn't referring to the shares as much as I was the options.
Yeah, James, it's just one contract per 100 shares of whatever underlying asset it is.
Okay.
So it's equal ratio, 100 shares to one contract.
Okay. And question, do you find that it's more expensive to trade the SPY than the SPX?
Well, we're taking advantage of the 3 option expirations on the SPY and the extreme liquidity in its options market.
Okay. Because the SPY is only like 1/10 of the SPX, I believe.
Right, exactly. And you're exactly right, James. And the reason why we don't do it on the SPX is, number one, the cost. Right, it's a lot more expensive to buy 100 shares of the SPX. I mean, you're looking at, was that 300 grand, right? Just to buy 100 lot shares. But the whole reason why we do it, James, is because we can take advantage of the 3 intra-week option expiration periods that the SPY offers.
Okay.
Okay,
Great,
and then yeah, absolutely. And it's nice because it kind of condenses our time frames as well. So it basically allows us to get a little more premium that way, and then also to tighten up our time frames just a little bit on our core position.
Okay, thank you.
Now, let me ask you guys, let's go over these 3 charts right here. So do these all make sense to everybody? Right here, these 3 charts? The bullish loose option collar, the neutral tight option collar, and then the bearish inverted option collar. Do you see how we're leveraging the 100 shares of the SPY to finance whatever our outlook is?
Yes, it's a collar. It's almost like a risk reversal, where you're using your premium from selling a call to purchase a put.
Yeah. So let me ask you this, James. What happens if you wanted to short the market with a put and then you were wrong? What do you think is going to happen to that put option very quickly?
It's going to expire worthless. You're going to lose time decay, theta.
Yeah, you're going to lose a lot. So the whole point of this is we can buy the asset, sell the call option, and use that to finance the put. And if we're wrong, we risk losing $100. So it's just not an easy way to do that consistently and safely by outright purchasing put options. And so this allows us to bet in a certain direction with a huge amount of capital and have a low risk. Whereas if I wanted to try to do this with just outright put options or buy some call options on the VIX, you're going to have to use tiny position size, and then you got most of your cash just sitting there idling away. So these are our core strategies for how to play the market, are these 3 different setups. Now we can the one we did today on the TLT, actually this put option is right below the trading price, but the call option was way above. So I will modify these a little bit because I have the outlook right now that, hey, if the trade deal keeps leaking out good optimism, there could be some downside risk in the TLT, but if things go haywire, that TLT is going to fly higher. And so because I have the very tight collar on the SPY, here's what happens. If the trade war escalates tomorrow, I lose $1 on the SPY, but I am set up to potentially make more like $2.50 on the TLT, and I own twice as many TLTs. So I'm in a setup right now where I have very low risk on my TLT to the downside because I sold the put way higher up, or I bought the put way higher up. And then on the other side, if the SPY sells off, I only have $1 at risk. So that's the basic strategy here, is that when one gets caught off guard, the put option kicks in, and then you leave a lot of room on the other asset to generate the profit. Now, we haven't been in a period of time where we've used this very much. I think in the last 11 months, we've done this trade maybe 10 times, but it's highly profitable. And actually, the potential profit you can make from betting down isn't even accurately described in this chart. This is what you could potentially make at expiration, but we're closing these out before expiration. So there's some implied volatility that can add to the value of your long put when we are doing the inverted option collar. Let's see, what about some other traders out there? Wendy, is this a trade you feel like you could put on?
Yes, I usually just buy and sell the option part, but not the position.
So do you see the value of buying the asset and then leveraging that asset to finance your actual outcome?
That's the part I don't understand.
Okay, so yeah, let me review this. So in this example, the SPY's at 298. We'll just round up. Okay, so I own this asset. It's a block of 100 shares of the SPY. Not many, a lot of people do, but a lot of people don't have 30 grand to put up to own that asset. Now, because I own that asset, it gives me certain rights. And the right we're going to take advantage of Monday through Friday is the right to sell a call option. So in this example, I can get paid $2.19 a share, or $219, to lend out my 100 shares for a 48-hour period. So that's quite a payday. The catch is I'm agreeing to sell it for $2.97. That's $1 less than they're worth. So I'm getting paid $2.19 a share, but I'm agreeing to give this call option buyer the right to buy them for $1 less. So my net profit on that part of the trade is $1.20. And that's if the market went higher and they actually exercise their right on the call option. So I'm short the call, but I've used that $2.19 to actually turn around and buy an in-the-money put option. So this put option is more valuable than the SPY is even worth right now, because it's starting at 300. So in this example, I was almost able to collect just enough money from selling my call to completely finance buying my put option. And so instead of going and risking $227 to say, I think stock market's going down, and if I'm wrong, I'm going to lose 100% of it or most of it, I can actually get a nearly free bet by just selling a covered call. So in all three of these examples, we're consistently selling call options for income, and then depending on our market view, either keep that for income or use it to bet down. So in this case, we're bullish. I'm collecting 33 cents, and I'm spending 46 cents on the downside protection. So I'm not making any income from that. I'm just giving myself some downside protection. So let's say Trump says, hey, we got new tariffs coming up. Stock market sells off $5, $10, $20 in a 48-hour period. It doesn't matter. My maximum risk is $3.10 because I had the foresight to buy the $2.95 put. There's my insurance policy. So we call these atomic bomb proof. The stock market could fall to zero and you still get $2.95 a put, or $2.95 a share of SPY because you bought the put. So this is where we think the market will travel higher, or at least the SPY would in this example. In this example, we're not so sure the SPY is going to travel higher. So I actually collected $153 selling the call option right at the money. So it's trading at $298. I'm agreeing to sell it for $298, but the guy who gets the rights, he has to pay $1.53. So he's only going to exercise his right if the SPY goes up by more than $1.53, because that's when he would start making money. From my point of view, I wasn't so sure it would go any higher, and I'm perfectly happy making $1.53 profit. But on the other hand, I'm not perfectly okay with having unlimited risk to the downside. And in fact, I'm never, ever okay with having unlimited risk to the downside. So I took about a third of my potential profit and I bought some insurance. I bought that 296 put. So in this case, if the market just stays exactly where it is, we walk away with $100. Now, let me ask you this. If I can make $100 3 times a week, 52 weeks a year, how much income is that? Just on one block of 100 shares. So $100 3 times a week is $300 of income times 52 weeks a year. Now, sure, there's a few trading days we're off, but that's $15,000 a year of income. Now, we're not trying to hit a 50% return, but it just illustrates how powerful this strategy is by taking advantage of what I call stock speculators. People who want to buy call options or buy put options for that matter, when it's not hedging, they're trying to get rich quick. They're trying to make 50, 100, 200% gain in a very short period of time. And so just think of the casino. They don't build casinos for free. And so the business of selling these call options is highly profitable, but it's something that only rich people do because you have to have the asset to get that right. So we have to have 100 shares of the SPY to have the right to sell a call option. And so that's the whole beauty of this whole system, is that we put up the risk in capital, and now we're something like a bank. We're loaning out our shares to speculators and then using that loan that we're giving them, that money they're paying us, to finance downside protection or even a bet to the downside. And it's almost for free.
Another analogy that I've heard that might be helpful is that you're the landlord and you have an apartment and you want to rent it out, and you're renting out your shares instead of the apartment, and you're getting your rent.
Yeah, this is like Airbnb, plus you're buying insurance in case they trash your house.
Right, that's true. Yes.
Because we don't want anybody trashing our house, but we love the income, right?
Yeah, I mean, it's better than letting your apartment just sit there empty and you're not getting any return for it.
Yeah. Or even worse, let's say you're holding cash and you know your government's trying to deflate the value of your currency at a rate of 2% a year. We did the math. Actually, I think it was Tom was asking yesterday about Elizabeth Warren. What's so bad about her 2% wealth tax? Well, it takes 36 years at a 2% wealth tax to go to zero. I guess you could do that to infinity, but yeah, so in the better part of 15 years, if they can keep up their 2% inflation and you just sit on your money, you'll lose half of your value in the next 2 decades or less. Okay, so these are the 3 most critical option trades. This is all we do. You can go do, iron condors and butterflies and all kinds of crazy shit. But you're not going to get a better risk-reward profile than what you're seeing here today. And that's because we have to put up the risk capital to become something like an investment bank. And we're in the game of renting out shares to stock speculators. It's something like taking candy from a baby. And then we're taking part of that candy we've stolen from the poor little baby. We're buying ourselves some insurance. And think about not having health insurance or any other insurance. most people have their portfolio with zero insurance right now, and they're sitting at some ridiculous return on the SPY in the last decade. So is it time to play it safe? Probably. All right, I'm gonna go forward now and kind of review what's under the hood of these assets, and then we'll probably take another break, see if there's any questions. And then after that, we can start to go back through history all the way through World War I. We're gonna really focus on a handful of time periods where the relationship of the stock market and the bond market protecting one another decoupled and didn't work, and why I think that's coming in the next couple of years. Okay, so the SPY ETF has grown substantially. When I first started making this presentation, it was at something like $160 billion. So it's grown by $100 billion in assets by my account in the last 12 months. And the average trading volume grew from 16 billion when I first put this presentation together to 20 billion. So it is growing at rapid pace. It's putting out hedge funds. Hedge funds are closing left and right. They can't compete with the SPY. It's a beautiful product that automatically rebuilds itself every day automatically into 504 companies. And you're going to be shocked by how big the position sizes are. They're tiny. The biggest position is Microsoft at 4%, Apple 3.8, Amazon 3, Facebook 1.7. If you own a stock right now and your position size is greater than, let's just throw out the biggest in the SPY, 4%, then you think you're smarter than the SPY, which has outperformed almost every hedge fund in the world. And bottom line is you probably have way too much risk in the wrong company right now. So if you do have a big position size in equities and you're really trying to play it safe and protect your nest egg, these are really the only 10 companies that you should even be considering in your portfolio if you were to build a stock portfolio. And look at the income of these companies: 39 billion, 55 billion, 12 billion, 37 billion. These are just massive, massive businesses. And as we go down the line, you can see some of these gigantic companies barely have a 1% position. Bank of America, 1%. Intel, 0.9%. AT&T, 1%. Walmart, 0.5%. So again, if you see that your portfolio has big position sizes in some of these companies that have tiny positions in the S&P 500, just realize most of the money in the world is not buying individual stocks anymore. They're all waking up, smelling the coffee, they're buying the SPY. When they buy the SPY, those funds automatically flow primarily to these companies. So you know, if you own these top dogs, you have an automatic stream of buyers nonstop flooding into you from index products. So that's one important thing about the SPY, is that it's going to help you improve the quality of your equity portfolio dramatically and simplify it. Now you have one stock to track instead of 10, 20, 30. Okay, so the next piece of the puzzle in our portfolio is the emerging markets. What's so important? Well, $25 billion in assets, so it's about 1/10 the size of the SPY. Its trading volume is a lot less. It has 1,059 holdings, and it's primarily investing in China and all of its trading partners. So we're looking at Hong Kong, which is the access to China, South Korea, Taiwan, India, Brazil, South Africa, Russia, Thailand, and Saudi Arabia. And most importantly is the position in Alibaba and Tencent. These are two of the top 10 richest companies in the world. They're growing at rapid pace. Alibaba's on track to be a bigger company than Amazon. Tencent is a gigantic software company that is growing at rapid pace. They're buying everything they can get their hands on. And these two companies are supported by their government. They subsidize their industries, so they also have unfair advantages in the world, at least right now. Now we're seeing things are starting to change. But again, it's 1,000 companies, so there's extreme diversification. Some of the other big companies are the Taiwan Semiconductor, Samsung, Naspers is another Chinese software company, and they're just growing. They have bigger numbers. They're growing at rapid pace. Alibaba just had a $30 billion 24-hour sales day, and so a lot of money is betting on emerging markets. Now, once again, if the U.S.-China trade war escalates, that doesn't mean we're just going to be a bag holder and be long the emerging markets. In fact, we can make much more money betting down on it if the trade war were to escalate. So I'd actually hope it does from a money-making perspective. And you can just get a feeling for how broad this portfolio is. JD.com's a 0.4% position. And I'm going to skip through this just because we're starting to run out of time. I'll just look at some of the highlights. China started off just ripping off everything, sure. But now they're starting to innovate. They're taking what worked for us and they're changing it for their Asian massive population. And so they've got WeChat instead of Facebook. Email doesn't exist out there. They only use WeChat. They don't use cash or credit cards. They pay for everything with the phone. Instead of Amazon, they have Alibaba. Instead of Starbucks, they have Luckin Coffee. They're working 9 days a week, 9 hours a day. They've got products going global with billions of users, 1 billion users with TikTok. So they're starting to compete with Facebook in terms of users on phone apps. And they're doing it with unfair business practices. So they definitely have an edge as long as the world lets them get away with that. So in our normal boot camp, we'd spend a lot more time on that. But the bottom line is it's worth having a position. And there's potentially more profit to be made in the emerging market ETF versus the SPY if everything goes hunky-dory and we don't escalate. Okay, GDX is the gold miner ETF. There's only a handful of gold companies that actually have access to capital to get that barbellic metal out of the ground and sell it while they have time. By my calculation, they have maybe at most 2 years to profit from this gold rush until things start to crack, and that'll probably be the top of gold and the gold miners. So once again, I've noticed a lot of people end up with big positions in tiny gold mining companies. Those companies aren't going to mine any gold. All they're going to do is a bunch of IR ads, raise money, pay off their executives. They're not going to mine anything, and they're going to go run some more ads to raise more money. So one of the people I like to listen to is this guy named Main Street for Wall Street. And he's all about this Sandstorm Gold Company. For whatever reason, he loves them to death. But in the GDX, the main place people go to who have big money to invest in gold miners, well, Sandstorm's only 0.5%, and he's all in on that company. Okay, now if the bubble does continue to grow and we get more fear, the potential for us to rotate out of gold into silver is definitely on the table. And our typical plays will play the spot price first, let that get elevated, and then rotate into the miners. So if we saw miners have a serious rally, we might rotate out of gold into silver, which can have some incredible moves, and it's even more volatile than gold. Okay, so let's take a look at some periods of time where our strategy broke down. And that's just blindly being long stocks and bonds. Now, as you can see, we're very aware of the trouble ahead in our program and look forward to these problems because it'll allow us to make larger than normal returns. Okay, so the big thing is inflation. And I want to point out this period in time on the Dow, 1965 through 1980, you had some rallies, but by and far, you just had a 15-year bear market. And in fact, it took you 30 years. If you had bought in 1963 and held, you'd be back to even in 1990, so 3 decades. So ask yourself, can you afford to have a 30-year drawdown just to get back to even? Probably not. So what's inflation? They call it the CPI index. The catch is they're constantly manipulating this to make it look like it's lower than it really is, at least by previous formulas, and we'll take a look at that. Here's your annual inflation rate, and the big picture is that we've been in a trend that is going towards zero, and if we get below zero, major problems happen, and if we get too much inflation, major problems happen as well. And all of the great recessions and moderations and periods of downturn have been caused by prices getting out of control. And so you can see these spikes in the blue causing these major meltdowns several times in history. Here is a chart that shows you what the Federal Reserve will do when they think inflation is getting too hot. And the red line is the federal funds rate. The blue line is your CPI. And so they hike the rate up above the inflation rate to curb inflation. And so you can see every single time we do that, sure enough, you get yourself a recession right after. That's the gray bars. And then inflation goes down. Now, in this period of time, leading into the Cold War and into the 70s, we had created so much money and so much inflation that no matter how high Paul Volcker spiked that interest rate, the inflation wouldn't go away. He'd spike it up, cause a crash, inflation would go down for a little bit, and then all of a sudden it comes spiking right back up. So then he would follow suit and raise the rates even higher. It would work in terms of getting inflation down. You get another stock crash, you get another bond crash, and he kept doing that. And one after another, the rates climbed all the way to 20%. So that is the magic sauce that has created the 40-year bull market in stocks and bonds. And you can see we're at the end of the rope. The best case from here is maybe the Fed can get away with bouncing it around 0 and 2% back and forth like they've been doing in Japan until they get inflation. So just like clockwork, you can see the GDP goes negative every time we spike the interest rates. So if we make the cost of debt expensive, the world stops growing. Pretty simple. Also, if we can predict what the Federal Reserve is going to do with rates, we can predict the bond market. You can see clearly that these bond prices are like a magnet to that federal funds rate. And now here's the scary thing. They are manipulating that CPI to keep it artificially low so that we don't have to deal with the pain now. And so we can see certain things have gone up in inflationary terms dramatically, like medical care, housing, and in the next chart, the worst of all, college tuition. The second the government starts to bail out any given industry, you see massive inflation. So the big story here is that we guaranteed the banks that if they loan out college tuition, that number one, we won't allow anyone to bankrupt that debt, and two, the government will guarantee it. Aha, so the colleges knew that meant raise your price because the banks will pay for it, and when the students don't pay off the debt, well, the Federal Reserve will bail out the banks. And so we've seen that in everything they touch, we get massive inflation, and that's why we have populism rising all around the world. The general problem is most people's income has stayed relatively flat while their cost of living has skyrocketed, so they're feeling the pain. If we look at the inflation rate based on the CPI in 1990, we're right at 6%. So if that were the case, the federal funds rate should be at 6 or 7%. And in fact, if you look at the 200-year average cost of money, it's 5%. So we are way below the norm. If we go back another decade, the picture gets much more stark. Not only is inflation near 10%, it's in a clear uptrend. If it's in an uptrend, you need to be pulling a Paul Volcker move right now to curb inflation, get misallocation out of the economy, and rocket that federal funds rate probably up towards 12 to 15%. Okay, but they're not doing that. And meanwhile, we have unemployment getting to all-time lows. If you listen to all the business leaders, they're talking to the Fed, they're having huge problems. They can't find employment at a cheap enough rate. So we have labor now demanding higher and higher wages, putting pressure on prices and limiting the profitability of these companies. So you can predict what comes next. Now let me stop really quick and see if we have any questions out there. John says, do we use the same colors? Yes, we use the same color strategy on all 4 ETFs. And if you do join our program, you'll actually start to learn how are we going to change the ETFs during different market environments. So probably for a year or two, we're going to be doing these exact ETFs. I don't see us changing those for at least 2 years. Now, the trade war could expedite the timeline. I see you unmuted. James, you got a question, bud?
I don't know if you covered this. I had to run and catch a phone call, but the U.S. Government debt, I guess, has hit over $1 trillion.
Mm-hmm. Yep.
I read, I think, just about a week ago.
Yep.
And
so that's really important. So we're creating a excess of debt that is just too big. So without the Federal Reserve buying government bonds right now, what do you think should naturally happen to the yield on a bond? You think it should go up or down if we're creating larger and larger quantities of bonds?
it should go down.
Well,
because if you're selling, well, let me see. Your question was if you're selling more bonds.
yeah. So if the government has a oversupply of bonds, do you think they're going to get cheap interest rates or expensive interest rates?
Probably cheaper because they're flooding the market with quantitative easing.
Well, let me ask you this. If you had a daughter who, loves to go blow money and she has no job, do you think she's going to get a high credit card interest rate or a low credit card interest rate?
A high interest card rate.
So how would you, summarize America? Are we like a very frugal spender who spends less than they make? Or are we more like that daughter who,
We're like Pac-Man.
Yeah. Yeah. So naturally, the yield should be spiking. Bonds should be crashing right now. We're spending more than we make. But so why is the opposite happening? And that's what's so critical here. That's why the Fed has to lower the interest rates. They know that we don't have a frugal America. We've got Pac-Man, like you said. And so how do you keep people buying these bonds? It's not for the yield. The yield is just about below expected inflation. So no one's buying the bonds because they think they're going to enjoy 2% a year when the inflation's, they've told us they're going to make sure they get inflation above 2% a year. They're not doing that. They're doing that because they know the Fed is trapped. Either the US government's not funded and the cost of debt goes extremely high, or they control and support the bond market. And so that's what they're doing. That's why they're doing QE, and that's why they're lowering rates. That gives everyone the impression that they can buy the bond today, yields will go lower tomorrow, and they can sell that bond for a profit to the Fed. And so that's why you have this phenomenon all around the world. It's not just in America. There's $188 trillion of government debt circulating out there, and they're all stuck in the same predicament. So we're living in a world of opposite, and it's bizarre. But because the Fed manipulates the market, we can predict what their actions will be. And they're going to print a ton of money, and they're going to lower those rates. Otherwise, the U.S. government won't be funded. And it's just as simple as that. So rather than go out of business, this is the question. Are they going to sit on their hands, let yield spike, let the interest on debt get out of control?
No.
Not really. I doubt it, because that's all, that would basically fire himself. His option is to try to prevent it by lowering rates and doing QE. And what have they done this year? They've lowered rates.
Himself being Powell.
Sure, yeah.
Or Trump or both.
Oh, no. Well, Trump wants the rates lowered.
Yes.
But no, it's Powell. Powell is is in control of this. But it's really, they call it the Federal Reserve. What a joke. There's nothing federal about it. It's owned by all the banks. So the Federal Reserve is there to keep the credit market intact and to support the banking system.
And also, are they pumping in money for the repo overnight rates?
Yep, exactly. So that's a little different. So the repo is probably someone has lost a lot of money that is borrowing to stay alive from a primary dealer. So the repo the repo markets are only available to a handful of primary dealers. And that's a very lucrative position. So that's your JP Morgan, your Goldman Sachs, Bank of America, all the big banks. And so they're just saying, all right, here's all my treasuries, lend me some money overnight because I've got to lend it out to someone else. And because of all the banking regulations, I can't lend him any money overnight, even though it's a guaranteed profit, because I don't have any cash available. Every penny I have is allocated for. And so that's where we're at right now. And every time we've been in this predicament where the Fed is lowering rates and printing money, there's been trouble ahead.
So that's adding to the balance sheet.
The repo is a revolving line of credit, so they have to return that every night. And it's just like a loan that keeps getting pushed. But yeah, if you listen to Jamie Dimon, he's telling them that they need at least $300 billion right now, and more like a half a $1 trillion, and that will relieve the money market. So somebody lost a ton of money, or a group of people. I'm guessing out in Asia. We know SoftBank lost a ton of money with WeWork.
WeWork, yeah.
And they were dealing with JP Morgan. We know HSBC Bank, a huge European bank, lost a ton of money trying to protect the Chinese currency in the exchange market and the futures market. So we know there's been some big losses in there. We know Deutsche Bank has been on the verge of collapse, a big German bank. So those are just, three definite known problems out there that we can be paying attention to. But yeah, there's definitely some problems under the surface that the S&P 500 is clearly not pricing in terms of risk.
But they're trying to divert us by saying, don't mind that man behind the curtain. It's sort of like Wizard of Oz.
Yeah, Powell's job is to keep people calm and try to keep the banking system intact. And so, the name of the Federal Reserve and, all these obligations to the Senate and all this, a bunch of smoke and mirrors. Really, their goal is to keep the banks running, and at the end of the day, bailing them out when they need to. So it's really quite a crux, but that's the world we live in. So that's who we have to deal with. All right, guys, I'm going to jump through a few more slides here, coming up on 2 hours. And I don't think we'll get through the whole thing, but okay, so let's look at some periods of time. World War I, what we have here is your inflation on this column right here. So note the high levels of inflation in World War I, followed by deflation. Now this is a period of time where we were on a gold standard. For the last couple hundred years, there's so many fascinating stories of these different governments doing currency wars. So the strategy would be to go get all your allies to go deposit a bunch of foreign money into a bank, and then get everybody, and then they'll go loan that money out to everybody. and then to have all your buddies go in and try to cash out at the same time and convert it into gold. Now the bank has no gold, everybody's freaking out. And so this was done over and over and over again by all these European countries. So it's quite chaotic. And then we go into the 20s through the 30s. We get out of World War I. For the US, we were able to pretty much take up, I think, 2/3 of the entire global supply of gold. So we had more gold than we knew what to do with. We became extremely rich. And meanwhile, everybody over there in Europe was suffering, from the most horrific losses of human life. And what was worse is they were so obsessed with reparations from Germany. They all had lost a fortune trying to defend themselves, and they wanted Germany to pay them back. The problem was Germany didn't have the money to do it. So what did they do? They did all kinds of crazy stuff. The story's fascinating. They ended up creating new currencies. The first currency completely hyperinflated, went to a value of 0. There's photos of kids building houses, little plate houses out of $100 German bills. They created new currencies. They tried to print money to pay everybody what they wanted. At the end of the day, they just couldn't do it. And so all this greed and anger turned into a global depression, because when Germany went bankrupt, it took everyone down with them. Now, Ray Dalio loves to compare the current circumstances we're in to that period of time. So he'd say we're right around 1929. Think of the roaring 20s, everything's great, misallocation of capital everywhere. The rest of the world's not doing so great. America's doing wonderful. So there's a lot of parallels that I can see that he likes to draw to this time period. You ended up with the Great Depression, and it lasted a decade. So my forecast of how long these different periods could be maybe too short. So this may last longer than we expect. Here's a look at the Dow. So you can see during that high level of inflation during World War I, we have a nasty stock crash, not nearly as nasty as this one. After we get out of the war, low inflation, we've got plenty of money. Stock market rallies from 1,000 to 5,500, but guess what? You gave it all back and then some in the Great Depression. We come out of the Great Depression with massive spending programs, all kinds of goodies, social nets, and the Cold War. So we're spending money at rapid pace. Inflation's under control during this period. This reminds me a little bit more of where we're at. I think Ray Dalio likes to scare people into his fund, but I can see the correlations. I like this correlation a little bit better. And what I want you to note is low inflation from pretty much 1949 through 1965. But after that, after 2 decades of low inflation, all of a sudden we can't keep it under control no matter what we do. So from 1966 to 1981, you can see inflation rise and rise and rise until it hits 13%. And so just like magic, during the period of low inflation, stocks go from 2,000 up to 8,000. And then soon as inflation gets out of control and we have to start raising rates, we get the 15-year bear market. Now, sure, there's some rallies in between. That's when they're cutting those rates back down. But then inflation came roaring right back. And so it took 15 years to work the misallocation of capital out of the economy and to get a healthy situation. And so what did Paul Volcker do during that period? He ramped up rates, dropped them, ramped up rates, dropped them. But at each low was higher than the past low, and each high was higher than the previous high. We ended up with interest rates tapping out at 20%. So this is the setup. This was a very tough period of time. This is the setup that gave us that 40-year bull market afterwards with some little mini crashes. And so you can see inflation went from 13 and worked its way all the way down to modern day inflation rates, which are in the 1% to 2% range. And here's your stock market for 2 decades. Sure, a little pullback in the 90s, but not much. And what did we do with policy? we slowly lowered those rates. That's the magic sauce that made this bull market possible. And now we've become extremely sensitive to inflation and changes of interest rate. And so the more money and the more debt that's accumulated, the more hypersensitive we become. The second we got a 3.4 print in 2000 and a 3.8 print in 2008, we were in the middle of a recession and a crisis. But they still had some ammunition to save the day. They lowered rates by about 5.5% and printed up trillions of dollars. And so you can see clearly how they fixed that problem, or at least band-aided it. But now, what are we going to do? We don't have anywhere near 5% to drop. And so predicting what happens next doesn't seem that difficult. They're most likely going to drag their feet and drop these rates as slowly as they can. Normally, they wait to do QE till we have a stock crash. Now they're doing it before a stock crash. Now we're cutting rates and doing QE at all-time highs. So they're clearly very concerned. And it's not just the Fed. There's 23 central banks cutting rates this December. So it's a global phenomenon. And now we're sitting on this massive rally, a huge bubble. This thing is leveraged beyond belief. But people think it's fine. They think there's no risk. They think even if there is a crash, it'd be better to buy and hold than realize any profit and pay tax. But they just don't understand that we've run out of room to keep expanding the monetary supply. And now we're going to reverse course. We're going to be entering a period, you got to ask yourself, are we on the verge of runaway inflation, or are we going to be able to bounce it up and down a couple times first?
It's almost like an addict that needs a fix.
It is, absolutely. Yeah, absolutely. So once you get the big picture, you can see, rather than not have a purpose, they're going to do what they can. They can lower those rates as slowly as they can get away with it. They can gradually increase the QE to support the bond market. And then that's really it. Then they have to hope that we create some real productivity and that we can create growth at a cost that's less than the increase in debt. Right now, for every dollar we spend in debt, we're only getting 50 cents of growth. And so that's why growth continues to slow and the interest on debt becomes more and more of a drag.
Also, the trickle-down economics hasn't really worked. I mean, they did the tax cuts, but they really didn't get any bang for their buck.
Yeah, the most interesting thing I've heard from Jerome Powell most recently that I haven't heard many people comment on, which surprises me, is he said that, this whole idea of top-down wealth distribution. So here's the problem humans seem to have a trouble solving. As we know that as an economy grows, as people are born, as technology increases productivity, that we need to increase the monetary supply. But how do we go about increasing that monetary supply, and how do we distribute the new money is where a lot of these problems arise. And so right now, we go back to, I believe it was Bretton Woods, all these bankers go over to the secret island and come up with this plan to create the Federal Reserve, which is going to be paying close attention and monitoring themselves. And so they have this wonderful system where all money creation goes to the primary dealers, and then they get to choose who to lend the money to, which might make sense. But what they're figuring out is they should only lend money to mainly corporations. And then the corporations are saying, well, you know what we're going to do with this money? We're just going to buy back our own stock. And from the CEO's perspective, sure, because all his worth is in that stock. So the money is not going into the economy, it's just going into the assets. And so what was interesting about what Jerome Powell said is they see that this method of increasing the money supply is only benefiting the 1% who own these assets. And so now he was talking about, and it's not creating price inflation. So they want price inflation. If people believe they can hold on to their dollar today and buy more goods in the future, money is going to halt. No one's going to spend anything because they're going to have this thought that if I hold, I'll get a better price in the future. So that's why they want this inflation, to keep people spending, keep the juice running through the system. But what Powell said in, I think about a month ago, when they did the most recent rate cut, is that they see it's not creating inflation, and they're working on a new method, a new tool to force inflation. So I have to wonder, is that your monetary theory where you're going to start putting money from the bottom up? Because that surely would create inflation. So I don't know. He talked about it very briefly, very ambiguously, and he said it's coming out by next summer. So we'll see what on earth they've schemed up for trying to get a little inflation in there. Any questions out there, guys? I'm going to flip through a few more slides to give you a feel for what the day in the life of Jason is like. And also, if you do end up joining our boot camp, my goal is to turn you into a kind of a clone of me. So I'm going to go over some of the resources I use to make this strategy easy. First of all, I really like Ameritrade's phone app. A lot of our clients are trading 7 figures with this system from their phone on the go. They're taking trades in the airport, they're taking trades in the restaurant, and you know, there's plenty of people doing it from the computer as well. But Ameritrade's phone app is beautiful. Our trades are so simple. You can easily do this from your phone on the go. So that's one. 2, I recommend the YouTube phone app. And in our boot camp, we give you all the top publications I'm following, which are numerous, but probably averaging, I'd say, 8 hours of content a day on here. John says, very interesting. Where do I find the program plans? John, is it okay if Dean gives you a call after the webinar and he can go over all the packages? Because we do have a handful of programs depending on you know, how often you want to trade and whether you want to do our boot camp or if you just want to take the trades. So the boot camp's goal is to really teach you what this lesson's been all about and plug you into the same resources I'm following. Whereas the advisory, you're going to get, you know, 30 to 40 minutes a day. Okay, sure, John. Did you save his phone number? The advisory, you're going to get the reasoning behind the trades in the daily update. But most of those people, they mostly just are, you know, they're taking the trades and that's it. They get the text message. Sometimes they don't even watch the video. They could care less. They get the idea. They trust that I'm going to provide the safe trades with the right direction, and they're happy with that. So it's really the difference. This is just to give you an idea of some of the YouTube channels I'm following. Now, I'm not watching all of it, but there's a lot of different perspectives. And I want to point out that some of the channels I listen to are just bloggers who are traveling through China. They have nothing to do with finance. So I'm trying to get a real look inside of China. And lo and behold, I've got videos of guys riding bicycles all around China through these ghost cities. You wouldn't believe that they've built 25 cities the size of New York, and there's not a single person in them. They've got 56 million condos they've built that they couldn't sell. Nobody wants to buy them. Okay, and I've got your radical Democrats. I've got your ultra conservative Republicans. I've got people in between. I've got Russian media, Chinese media. I've got historians, so I can get perspective on the Cold War, World War I, World War II. You know, to be honest, I do need to improve my education beyond the last 100 years. But this just gives you a feel. I've got certain foundations that are all about evaluating the risks with China. So there's just so many different pieces to the puzzle to put it all together. Next thing I recommend is the YouTube TV phone app. It's different than the YouTube app. And so if you already have a bundle, you might consider canceling it. YouTube TV is only $50 a month. You can have it on your phone. You can have it on 5 devices. You can have 3 simultaneous connections. But from what I'm studying, it's CNN, Fox Business are the primary channels that I'm focusing on. So I get 2 different main perspectives from those 2 main sources, and then CNBC, which I'll just have kind of on in the background during the day. Twitter, another great resource. Twitter is can be overwhelming, so I do try to not have too many people to follow. But right now I have The Long View, I have Live Squawk, Donald Trump, Zero Hedge, Kyle Bass, Juan Talks, and then I have a few kind of niche outlets like Nancy Pelosi, Leader McConnell, only because we're in this impeachment problem. We got Elizabeth Warren, maybe the front runner for the Democrats, and then Jeffrey Snyder, who's really an expert on this repo madness. So I will alter which channels I'm following and try to keep it to as few as possible, depending on the market environment and where I think we have the most risk ahead. Another great resource that's free, Bloomberg phone app. Now, Bloomberg is now running for president. This guy has given away $9 billion, which is 5 times the supposed net worth of Trump. His net worth is $50 billion, and he's done it from selling Bloomberg terminals, which is incredible. But anyways, his phone app's absolutely free. In this app, I like to follow the currency market, mainly the Hong Kong and Chinese conversion rates against the dollar. That's been our best leading indicator for trouble ahead. And then I like to look at the futures market, commodities markets, and bond markets from that app. Another great tool is the Seeking Alpha phone app, also free. What's neat about this is we can make different watch lists. Now, I don't trade all these different stocks that I put in these watch lists, but like we talked about earlier, there's a few warning signals that we can follow. So like Deutsche Bank, HSBC, these are 2 big banks that are known to be under some trouble right now. Also, I can look at credit markets like the corporate bond market with LQD and HYG. What's also neat is they'll find specialized articles written by experts where they automatically flow those articles to you based on your tickers. So that's another good tool that I use daily. Another great tool is the Roku. That's the only little tool that can connect to YouTube TV and YouTube. So I got this all over the house. I like to build playlists and then put them on and sit back and relax and get as much content audio rather than having to use the old eyeballs. The YouTube TV app I like to run almost throughout the entire day on CNBC so I can hear any breaking headlines. And then I like to have my other phone ready to access Twitter and Seeking Alpha. So I actually have 2 phones rolling, and this is where I'm sitting right now. Those are all my little gadgets. The earbuds will help you get more content consumed. And then finally, the last tool I really recommend is getting an Amazon Fire. The phone and the computer are really not the ideal setup for reading the news. The best news source that I like to follow is really Bloomberg's newsletters for a more centrist or democratic angle. And then I like to follow Zero Hedge for usually more conservative and more advanced articles from hedge funds and the like. So I do use the Fire almost exclusively for hand-picking articles out of Zero Hedge and sometimes Drudge. And finally, the last resource I really recommend, if you go to bloomberg.com/accounts/newsletters, these are the newsletters they give out for free that I read every day, which will really keep you up to date with the least work possible. Okay, A Trader says, Elliott wave analysis is calling a top in bonds and stocks. And how will it work if they're going over down together for a long period of time? Good question. First of all, I don't think that will happen until, let's go back to how we think the bond bubbles are going to pop. So I call it, triangle market predictions. People look at Elliott waves. So, I'm not a person who believes that just because a technical pattern has arrived, that's going to be a self-fulfilling cause of a crash. I'm much more of a fundamental trader. Now, I love to look at technicians to try to predict levels, but I'm looking for a catalyst that's going to drive the market, because people are still pulling the trigger on buy and sell, and they're still making logical decisions with the best information they have. And so you can see in both of my forecasts, we end up in the same predicament, which is awful for 99% of all financial institutions that rely on the stock and bond market supporting one another. When one goes down, the other goes up, and vice versa. But as I've shown you, both of my outlooks end up where we have both crashing at the same time. But there has to be a catalyst to cause them to crash at the same time. And there's only one catalyst on Earth that would possibly make that happen. And that is if the Federal Reserve were to raise interest rates during a period of time where there was slow economic growth. And the only reason they would ever do that is because of runaway inflation, which I do think is coming. Okay, so let me just back up a little bit. So first of all, I want to point out, if that were to happen, and we were predicting it, that would not be a problem at all. So the reason why is because we would be using this option collar on both assets. So if I have a negative sign next to, oh, Dean's audio's off. Sorry, Dean, let me get you in there. And A Trader, I unmuted you too if you have a mic. And Dean, you're unmuted now too if you want to speak. But let me answer the question really quick. So assuming that both of those assets were to fall in tandem, I would argue the only reason on earth that that would happen would be if the Federal Reserve was raising interest rates and maybe even reducing their balance sheet. And we don't have to go back far in time. I want you to just think back to 2018. What was the Federal Reserve doing? And what ended up happening? We ended up with a stock crash at the end of the year, and we had bond prices hit a 3% yield by October. So they didn't happen necessarily at the exact same time, but they barely raised the interest rates to 2.5%. Okay, so they didn't do it for very long, and they did it during a period with no inflation. And so what did they do the second we started seeing financial problems? They immediately reversed course. They started dropping those rates right back down. So I would argue the only possible outcome where you get stocks and bonds crashing at the same time is when you don't have positive growth and you're raising interest rates. So you're raising interest rates in a bad environment because you have no choice, because there's price inflation. And the cause of that is after you pop these bubbles and the money gets out of the assets and into the real economy, then you get your price inflation. So I would argue that much more likely outcome is going to be we pop one bubble at a time, and then you have inflation and they both go down for a substantial time afterwards. Let me pull up these outcomes. Let me ask you this, A Trader. Do you think the trade war will escalate or not escalate between now and the election? And based on your answer, I'll show you what I think will happen in the markets and how we'll play it. Escalating. Okay, well, that's what I think as well. Hard to predict because, here's the catch to that. The Trump administration knows no president has ever been reelected during a recession during the election period. That's a fact. So he's highly motivated to make a deal. The problem is the Chinese also know that no president has been reelected in a recession. So it's really no surprise that the Chinese continue to do everything they can to piss him off. And it's also no surprise that they're not following suit with all the other central banks. Yeah, they want him out. Okay, so let's talk about what would happen if China forces Trump's hand. And so, you know, timing is so hard. And you can go back through my 11-month track record. And what we'll find funny is I've predicted most of the big events that have occurred, but I've been either early or late. So we didn't get the best return we could have had. And so despite understanding what was going to happen and even predicting it, to time it perfectly is almost impossible. So the goal of my program is really to design a portfolio that's safe, it's protected to the downside from our puts, and it allows us to just get the big idea right and safely generate a return. Versus trying to be aggressive and speculative and take on a lot of risk. You could have the right idea and then just get the timing off by a week or a month and end up with a huge loss. So here you go. How the bubble pops with a China trade war and impeachment pressure. Okay, so we have low rates, and more important than low rates is the... Oh, is that just hit? Yeah, it's escalating right now, huh?
Yeah.
Yeah, called it.
I thought that was really funny as you guys were talking about that, and I read through the news and saw that.
Yeah. So they like to keep us off guard. There's a 3-hour thing with CSIS, Strategic Institute of something. They're over in DC, and very interesting. And they play, one group plays China, one group plays the US, and they go through all these different circumstances. And what they ended up coming to a conclusion was that neither party can really change the other. So the outcome that they expect is that once they realize that, their next goal is not to really make a resolution. It's just how much can they slow the other one down without destroying themselves. And so perhaps that's where we're at. Okay, so it's not always just low interest rates. What's also important is the change of interest rates. So right now, we're in a period where they're lowering the interest rates. We know that's a fact. We've done it 3 times. After every single time, Powell tells us they're not going to do it again. We're going to wait and see. And then lo and behold, they lower it again. So we've got low rates. We've got low inflation, at least by their CPI right now. We have QE, so we're supporting the bond market. Add some fear. My expectation is a short-term sell-off in stocks. And we can go back in the Cold War and watch that stock market rally all day long. As long as there is no inflation, they can get away with lowering rates and printing money. And that's very stimulative and helps different countries protect their markets. So if the trade war escalates, I'm not going to be telling you to short the SPY for a year or 2 years or 15 years. Not yet. Not yet. Because we don't have the inflation putting the pressure on the Fed to pop the bond bubble by raising interest rates. In fact, it's going to cause them to quickly expedite to zero. So my expectation is with some panic, we could get a 3 to 6 month sell-off maximum in equity markets. We'll quickly reprice the fair value. And in that period of time, you're going to see a huge push in the TLT. Now, the bad news for the TLT is the end of the rope is at 0. Now, we've seen the European banks go into negative territory, but from all the best analysis I can find, far smarter than I am in terms of trying to diagnose the bond market, they all say the U.S. cannot go to, the only reason that we can have negative rates around the world is because there's a positive outlet in U.S. bonds. So we probably can't even get to 0 before it snaps. But there is some room for the TLT to go significantly higher from rates dropping towards zero. So if we get panic, well, kind of, but the bond market's trying to predict what the Fed will do. And so the Fed doesn't always do what the market wants. And so certainly the Fed has been changing its mind left and right. But yeah, to a degree, the bond market's been, supposedly demanding that the Fed make these rate cuts by pushing the rates lower. But regardless, the speculators in the bond market, they all know that zero's the bottom. So that's the highest price we're going to see on the TLT most likely, is pushing towards zero, probably not even hitting zero. So in this outcome, we're in a low rate environment, low inflation. We add some fear, we can get a panic sell. We know the Chinese have trillions of dollars hidden in all kinds of different funds where they could hit the sell button, not only on the treasury market, but also on the equity market. Now in the bond market, the banks are going to support the bond market. They're much more concerned with credit markets than stock markets. So my expectation with the trade war is gold and bond prices go much higher, and we get a short-term sell-off in stocks. Okay? And this could last for a substantial amount of time, and it's going to create a period where we go into massive QE and we dramatically start cutting rates. And that will most likely be when the stock market bottoms out and people realize, okay, bonds are near zero, time to rotate back into stocks and sell the TLT. So this is how you first take a lot of money out of the stock market, revalue it much lower, and push the TLT to extreme highs. And then you get your tug of war. Now stocks are severely devalued. There's free money. You're going to be able to borrow at near zero if you're a bank, if you're a primary dealer. And all of a sudden, your money floods back out of the TLT because they realize, number one, the yield's worthless, so there's no reason to hold it. And two, there's no more capital gains to appreciate because they can see the yield starting to spike. So then you get a rush of money out of the bond market because they realize there's no reason to own this thing. It's generating a yield below inflation, and now we're printing so much money that inflation is surely to come. So when the bond market realizes the Fed can't cut rates lower and that we're going to create inflation from massive QE, from a trade war escalation, then you get your bond sell-off. So I really, truly believe you'll see in this setup, stocks sell for a short period of time, then bonds sell for a short period of time until you get inflation. So we can go back and forth between these two, back and forth with lower and lower prices, like we saw from 1965 through 1980, until finally you get your inflation and the Fed has to increase those rates. So that's the only outcome I can possibly see where you have a substantially long sell-off in both asset classes at the same time. And it'd be a period where growth has been destroyed, so they wouldn't want to raise rates, but they have to because inflation is so high, and we're coming from the zero bound on the federal funds rate. So really, getting trapped at 0% interest rates is a disaster. And so I do think this can't come, but most likely not at the exact same time. And then eventually you get your reset, which is what we can all look forward to. And then investing gets easy. There'll be blood on the streets. Rates will be dramatically higher. And we're going to have this expectation that things have gotten as worse as they possibly can get. Stocks will have sold off at least 50, maybe 70, 80%. Bond prices will be dramatically discounted, and interest rates will be probably well above 5%. I don't think we're going back to 20% rates. Everything's so hypersensitive now that the supply of debt has increased so significantly. And then you get back to that period of time where, okay, We've gotten rid of all the misallocation of capital. Lots of private equity has probably gone bankrupt. Think of all these companies that all they do is they borrow at near 0%, and then they go create, maybe really neat products that we all love, but they're losing money. Well, that's going to come to an end. And then you get a period of healthy growth once again. But that's a long ways off. So from our perspective, we're either in this strategy where we have fear, or this strategy where we don't have fear for the foreseeable time. Now, this current setup is working because there's a little fear. So this does have a little fear to even get the Fed in the position where they're lowering rates and creating QE. So if we were to completely get rid of all fear in the market, which is highly doubtful, and then we would probably see a sell-off in bonds, which are pretty highly priced already, obviously. So this is obviously summarizing this as much as we can and simplifying it. But the point is to show you with a very simple portfolio and then the option callers, we can generate very safe returns with low risk. And I just want to show you guys this, and we'll probably have to wrap it up. We control the exact amount of risk in our portfolio at all times by how tight we position the option caller. So I'm comparing the risk I'm taking in the TLT to the risk I'm taking in the SPY to determine the width of these option callers. So the reason why we can't lose very much money and our biggest loss in a month is 1% is because we always have a put option below all four assets, and we finance that put by taking candy from a baby by selling the call option. All right, guys, any last questions before we wrap it up today?
Yeah, and team, make sure to save my number too. More than likely, I don't have your number, so just call me whenever you have a second. And the number is 505-322-7515.
Hello?
Is that Donald? Oh,
This is
Tom.
Tom. I got
Tom,
a
how's it going,
comment.
buddy?
This is Tom. I've got a comment. I wanted to tell the new people that might be looking at this. I started out about 3 months ago, joined about 3 months ago, and promptly I made the mistake and lost not a whole lot, but a modest amount on a stupid mistake. And in 2.5 months, I'm back. Now it's very slow, consistent growth, and I am slightly positive now. So the person early on that said something about they wanted slow, consistent, moderate growth, I think this is a winner.
Oh, thank you, Tom. We appreciate that.
And Tom has joined the boot camp now as well as the service. And we're having a blast with Tom. So thanks, Tom. Appreciate that, bud. Any other questions out there? And folks, if you don't want to ask questions live in the webinar too, I understand. Just give me a call after and save my number, and we can go over any question you may have. I've been following this for quite a while now, and I'm having a good time protecting my capital and growing it as safely and as defensively as humanly possible.
See, James, I see you got your mic unmuted. Do you want to say any final words?
No, I just want to thank everyone. And I was going to say thank you to Tom because I think he was answering my remarks earlier at the beginning if he was on right at 2.
Excellent. That's excellent. Wendy, you have any last comments or questions?
No, I'm very curious about the costs and things, so I'll call Dean.
Okay, great. Well, I hope you guys enjoyed the content. I'm sure this was nothing like most presentations you've seen, and hopefully we can get you guys on board. Wednesdays we have our normal webinar. We do invite our paid folks to join the freebie webinar, and a lot of them come in and say hi, so we really appreciate that. But if you want to keep the conversation going and kind of look at more specifics in terms of how we can optimize the option callers and what I think is going to happen when we're right, when we're wrong, the good, the ugly, then we would love to have you next week on the Wednesday webinar. So thank you everybody for your time. I'll throw up our little testimonial just to keep the lawyers happy here. And we'll get this replay out over the weekend. So if you want to rewatch this over the weekend, Saturday is when that typically hits the mailbox. And then next Thursday, we'll have another webinar, and it'll be very similar to this one. So we'll be going through the big picture once again, and obviously make comments on anything that's changed in the market environment. And things are starting, what do they say? Things happen very slowly, and then they happen all at once. So thank everybody for their time, and don't forget to give Dean a call. We'll get you going right away.
Thank you very much.
Thank you,
Thank
guys.
you.
Thanks, team. Appreciate your time.
Bye.
Bye.
Bye.